Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is January 29th, 2024. We have a very big week of earnings. We have 5 of the Magnificent 7 reporting this week. We also get the Fed's rate decision for January, but most likely we'll get the insight of what they're going to do in March. We also get the jobs data for ADP on Wednesday, and then we get the non-farm payroll on Friday. So let's find out where we're at and jump on in.
Okay, let's go over last week's market recap. For the week, it was a mixed market. We had gold down slightly, ag. The bonds were basically flat for the week, and most of the equities, the NASDAQ, S&P, and World were up about 1%. 3 top headlines, GDP came out, and it was an upside surprise. Number 2, after earnings, we're starting to see the margin shrink. And number 3, on Friday, we got the PCE report, and so inflation is moderating. So let's dive into those. Number 1 headline for the week is the upside surprise for the GDP. Even though last quarter was at 4.9, this quarter came in at 3.3. The estimates were 2.5. So yes, that did mean a slowdown, but for the year, that brought us in at a year-over-year GDP number at 3.1. But let's go into the numbers. While it was a surprise to the upside, it's not necessarily a healthy expansion because we have so much government spending that's happening in there. And so to garner a $329 billion increase in this economic growth, it's been required to actually $834 billion increase in debt. So for every $2.53 we are spending, we're getting only $1 in growth. That cannot be sustainable. So we've got to actually grow this economy without spending so much money, because if that was our pocketbook or our balance sheet, we would not make it. All right, let's look at headline number 2. The margins are starting to shrink. As you can see from this chart, right now with about half the earnings coming in, we are at about 10.7 on our net profit margins, which last quarter it was at 12.2. So bottom line is that inflation headlines, as inflation was going up, that gave them reason and cover to increase their margins without having to justify them. They can blame it on inflation. Well, with inflation coming back down, those days are probably over. And so companies are going to have to start cutting costs. They're either going to have to bring the prices down, or they're going to have to start cutting. And the biggest piece is employment. So we've got to keep a close eye on this. We really haven't seen employment and layoffs. We've seen some here or there, but we've got to keep a close eye on this to see how the companies are going to get those profits back up. All right. Headline number 3 is the PCE came out on Friday, and inflation is moderating. As you can see, last year we were in the 5% up to 7% when we added back in energy and food. Well, we're down below 3% at 2.9 and 2.6, and both of those came in lower than expected. So that is a positive. What we got to hope is that we don't see an uptick in this as we head through to 2024, but that's the Fed's preferred inflation gauge. So most likely, not this meeting, but the one in March, they're going to probably cut. And like I said, right now it's at 50% odds that they are going to cut in March. All right, let's take a look at the short-term chart of the S&P 500, and this is our equity chart. And as you remember, we started adding back in early November, and it's been a straight line up. So that's been extremely great because the market's been up about 12% since that time. However, we do have this gap, which I've talked about in previous sessions, that the market likes to close these gaps at some time, and that was during the Fed pivot, what they call the Fed pivot. And so if the Fed doesn't, if inflation goes back up and the Fed starts cutting and there's some issues, you could easily see the market come back down and test that out. It's not saying it's going to, but it could. All right, let's take a look at the bonds. And the bonds also basically was buy everything during that Fed pivot around November 7th. And the bonds went, the yield started to come back down, so the bond prices went up. Well, since the beginning of the year, bond prices have come down because the yields have slightly gone back up. So they're right there on that line. We're not in protect mode, but we're close. And we're going to have to wait and see what the Fed does or Fed says they're going to do into March. And that may dictate whether or not we continue to like bonds or we go back to protect mode on the bonds. All right, let's talk about the top 3 market movers for this week, Wednesday. As I said, we have that interest rate decision. And right now, 97% probability there is no change. What everyone's going to be listening to is what they are going to say heading into March if they give any indication on their next move. We get a lot of jobs data on Wednesday, Friday. Wednesday, we get the ADP employment. And then on Friday, we get that non-farm payroll for January. And right now, it's 180,000 is the estimate. And last month, we had 216. So we'll see if there is a reduction in new jobs. We also have a lot of earnings this week, and several of the big tech companies, like I said, we get 5 of the 7 magnificent 7, and here they are. We get a bunch of them on Tuesday: Microsoft, AMD, and Alphabet, and then we get the rest: Amazon, Apple, and Meta on Thursday, and then Friday to close out the week, we get the pharmaceuticals and the oil companies. All right, that's it for this week. Our next update is Monday, February 5th. As always, continue to subscribe, like, and follow, and we shall see you next week. Have a great week trading.